Hello and welcome to today's weekly wrap-up show, bringing you the conclusion to your trading week. I'm Kiri Bloor and today we're taking a look at France and Italy's disappointing GDP and much more with Phil McHugh, trading floor manager from Currencies Direct. Hello Phil and welcome along. Phil, the French GDP data came out much lower than expected and painted a particularly bad picture of their economy. Why do you think this was, and what effect do you think this will have on the Eurozone overall recovery?
Okay, the reason for the stagnation in French growth can be attributed to a fall, firstly, in French household spending of 0.5% and also a fall of 0.9% in business investment. But really, it's the fall in business investment that was quite concerning, as this points to anxiety surrounding François Hollande's economic programme. And it also is going to make it very difficult for him to achieve his goal of 1% growth through 2014. Another worrying factor for France was that its exports slowed down, and this really can largely be attributed to a stronger euro. And this, the fact that we've seen a stronger euro recently will have also impacted on the growth numbers for other economies as well within the eurozone. I'm talking about the eurozone recovery. I think the overall growth of 0.2% was disappointing, especially given a mild winter. However, it did show the fourth consecutive quarter of positive growth from the Eurozone. But really, it was Germany that contributed heavily to that growth. So really, overall, the Eurozone is still struggling to grow. Its inflation rate is low. And really, there's a lot of fuel to the fire for the ECB to act decisively in June.
It wasn't just the French who had disappointing figures. The Italians also had disappointing GDP data out. How worrying are these figures, do you think?
Well, again, I think it is worrying with Italy's economy. It was very disappointing. We'd expected that it had begun to mend. The forecast was for growth to pick up to around 0.2%. So the fact that it came in negative was a real disappointment. And I think it does have wider significance. The economies such as France, Italy, Portugal, the Netherlands, they're all suffering really from what I perceive as a strong euro. And this is really why the ECB are looking, one of the reasons why they're looking to act decisively to curb a stronger euro with monetary policy action in June. And also it will help with ECB activity to ease funding pressure in the Eurozone and hopefully pick up overall growth in the Eurozone going forward along with global growth. But it does really add fuel for the ECB to act, because economies like Italy and France are a better picture of the Eurozone economy than Germany.
The US Consumer Price Index came out yesterday and recorded their largest increase in 10 months. But it is believed policymakers worry that inflation is running too low. What are your thoughts?
Well, again, inflation is a concern. The US policymakers have raised that, and of course in the Eurozone it's a major concern. But I think with the US, strong producer prices for April should follow through gradually to a higher inflation readings in the coming months. And the Fed overall should move towards its 2% target when looking at the PCE index that it monitors more closely. So the next real feedback we'll get in that regard will be the end of May. And I expect the PCE measure of inflation to show around 1.6% for April, and that's an uptick from 1.1% in March. And overall, the improvements in the labour market recently in the US economy and anticipated follow-through in US growth does support a gradual rise of inflation over the next 12 months, which in turn also supports the ongoing tapering programme.
And finally, do you think a rise in interest rates in the UK will be used as a tool to burst the bubble on the ever-increasing housing market?
No, I think in his report, Carney made it very clear that monetary policy would not really be an appropriate tool to curb the housing market. It would really be a last resort and related to fiscal stability within the UK economy. Overall, I think Carney's now passed the ball to the FPC to look at tools to really try and curb an overheating housing market. I think the Bank of England will look at really the slack in the economy, and once this is used, it will be set for interest rate hikes on a gradual basis. But Carney did note that the overall wage growth has not really happened yet, and the economy is still on a starting journey towards normality. So the report was really more dovish than expected, and I believe this was probably more to target a stronger pound. Carney did mention specifically that the strength in sterling does challenge the balance of expansion in the UK economy. So really what he's doing here is talking down the pound, and he was successful with the pound falling against the dollar and the euro post the report. So going forward, really, I think there's more slack to be used up in Carney's perception, and it's really a grey area, and I think interest rate hikes will be pushed back as long as the Bank of England can.
That concludes your trading week here at Dukascopy TV, but make sure you click back to watch Ben Jones's interview all about the Malaysian GDP. But that's goodbye from me.